Welcome back to episode 15 of Meetup Exchange, a long-awaited episode. We were on hiatus last week, but excited to be back.
Another milestone. Just keep it rolling. Thanks for tuning in. 15 episodes in. Feeling good.
Huge. And we're ready to go. A lot of good headline stuff is happening, both good and bad. We'll try and present both sides. But the first thing on the docket is that we had some breaking news. I believe this was today, and James was able to pull this story in time, so I'll let him kick it off.
Yeah, just a few hours ago, as of Sunday, the 27th, we've got word that the Trump and European Union have settled on a 15% baseline tariff, which is pretty good news. There were threats that this could go up to 30%. So if if it wasn't that August 1st deadline was really starting to creep up.
Hmm.
So they're able to get a deal done before anything too intense went on. Alongside that, EU agreed to invest $750 billion into US energy and invest $600 billion into the US in general. So a few other contingencies there. And Trump also claims that US goods are going to face zero EU tariffs, which have not been confirmed, but that is his claim as of right now.
Yeah, this would be wild if all these terms were true and seems like a great deal for the US. And I'm interested to see Monday how the market responds to this because I could see a lot of people in the market thinking that tariffs were something that were gonna go away completely and not linger permanently. And it seems that that's the position that Trump has. So interested to see that, and also interested to see if this actually remains as one-sided as it seems to, that the EU is going to buy all our stuff, they're going to invest money into the US, we're going to have tariffs on their goods, they're not going to have tariffs on our goods. This almost sounds too good to be true.
We'll see. I don't know. Again, it's like the market that doesn't really care, so maybe it'll rip some more, maybe it won't. Who knows? I think I do think the general consensus though is that this is a good deal, considering that it could have gone up to 30%. That really would have had some negative implications given that the EU is our number one trading partner,
Hmm.
and that could have really put a put a fork in the I don't know what the saying is. It could have popped our tires, something. It could have
Right.
been that.
Yeah, absolutely. And I think what's good here, I think almost like regardless of the terms, is that they've agreed on something. We know what the long-term outlook is going to be, like no matter what the terms are, so businesses can plan around it. Unfortunately, I think whoever is president next is probably gonna probably repeal all of these and have its own way that it wants to promote international trade. Maybe not. And we saw like continuity of Trump and Biden on China tariffs, so maybe this is just a new era for U.S. foreign trade relations. But I think it's good to just have something in writing and business can say for at least the next 2 years, this is what it's going to be.
Yeah, certainty helps a lot just for planning out investments and overall business endeavors. So that's a good sign there. But amidst all this volatility that's been going on as a result of this, kind of what we want to jump into this next story. We talked a little bit before, but just Wall Street Journal came out with an opinion article just about kind of everything that's been going on the last few months with a lot of trade uncertainty and new policies and mass deportations. It's been a lot on the economy, and the markets have been going absolutely crazy. And kind of the theme of this is Wall Street's booming and Main Street is losing. But if you want to jump into it a little, Adam.
That is a good line, and it is interesting because we think about volatility is generally bad for everyone, and we've kind of touched on this before about I think in an earlier story where trading revenue at the big banks was going way up in periods of volatility, and this period's no different than that. So big banks are making a lot of money. But what isn't really captured there is like the big swings in foreign exchange rates and commodities prices and all these things that people trade. Those are make it hard for businesses to just do their normal operations because it's great that the person who's trading corn futures is making a lot of money, but if Kellogg can't buy cereal on time and plan out how they're going to do that, then that's not good for everyday families. So yeah, trying to calm the seas, I think, and this first story is probably going to be good for that, and just making sure businesses can properly plan. But that is the story, and I kind of wonder what it would take for this rally that we see in the stock market to we've seen it kind of branch out to other places in the stock market, but how does it get from there to the real economy and your just everyday workers? That path is kind of harder to trace.
Yeah, it's just a lot to unfold. And we'll talk a lot about kind of the difference between the real economy and what the market's telling us. But basically, just this theme that, especially for small businesses, they do need certainty. So Main Street facing tighter credit, falling hiring, margin pressures from tariffs. That's still a huge concern. And also some labor shortages we're talking about with deportations. So there are struggles there, but Wall Street just keeps winning. And it just seems like there's always a way for them to make money. They're making money off the spreads and the sheer volume of trades coming in and people trading off news that comes in. One day tariffs are going to be hotter or maybe less than, and then trade off the excitement or the fear. And they're just making money through that. And they're making it through the retail investor. And I don't know. I guess the key is to kind of to be invested. You have to put money in the market if you want to somewhat compete. I mean, Wall Street's probably gonna blow you away anyway, but it's better than sitting on the sidelines.
Definitely agree with that. And I hope that a lot of the money that we're seeing flowing into the big banks flowing into to tech that money is getting circulated in other places in whatever restaurants in home improvement and just all these other businesses that are surrounding these financial centers, even just thinking about the city or New York City that you have these big office buildings and then it like broadens out from that, but that we're gonna see the economy hopefully that money keeps flowing down the chain and trickling down though. We've had that discussion before that there are a lot of skeptics of that philosophy out there.
Trickle down theory. I don't know. But basically, I guess when you're looking at it from the other side of this opinion article, it's like, okay, there's some volatility right now, but the goal from tariffs, I think at the end of the day, was for national security and for reinvestment in the United States. So we have seen investment into the United States, and we're seeing even with this deal, it's going to come out to over $1.5 billion worth of a trillion and a half dollars, excuse me, of additional investment into the United States from just the EU. So
Whoa.
if that can really materialize itself and truly circulate around the economy and make our nation richer, that's the other side of the argument there. I don't know.
Absolutely. And not even to mention on top of that 1.5 trillion is the tariff revenue that's hopefully going to help our deficit issue. So that those are all good things and we'll see long term whether that plays out. Hopefully it does.
100%. But how about some of these? How about this next graph we have? It's
I can take
annualized.
this one.
Yeah,
Yeah.
yeah. Lead the way.
And this is so annualized return by decade, and this is just trying to almost think about the larger context of what we're experiencing right now in this prolonged bull market and maybe how it's different from than some of the other ones we've seen. So if you're just listening to this, we have the S&P annualized total returns by decade. So in the 1980s, it was 17.3. The 1990s, it was 18.0. In the 2000s, this is financial crisis, this is dot-com bust, -1%, and then 2010s rebound 13.4%, 2020s so far, we're at 14.4%. So a lot of good decades in there. And what I kind of wanted to think about is, how different or similar is what we're experiencing now in the 2020s to what we were experiencing in the 80s and 90s, and kind of what the big names looked like then. And I kind of put them down the bottom. I won't read out all of those, but the basic point that I wanted to bring up was that in the 2020s that we have feels like a lot of our eggs in this tech basket, whereas in the 1980s it seemed to be a lot more spread out into like what were the hottest stocks, what were the biggest winners of that decade, and kind of just wanted to pass it to you if you had the initial reaction to that.
It's tough. Yeah, it's like Mag 7 leading the way, and we've talked about the concerns about maybe some over concentration there, but it is a little bit weird when you look back at the 80s and you have IBM and then Coca-Cola and then Exxon, so just fundamental staples. And you just, I don't think some of those like these non-tech companies are still going to be great in the future. I think maybe they're just undervalued at this point after years of the Mag 7 taking all the spotlight because the markets do at the end of the day come down to supply and demand, and
Hmm.
especially in a world of increased, social media and everyone's just pushing these big companies, they could just continue to grow. But I think there's a little bit of a pullback, and we'll talk about kind of a doomsday scenario a little bit later. But I just think it's going to make these companies look even more attractive, and people are going to shift to some of these safer names that still have great fundamentals. Coca-Cola is still a great company. I know Warren Buffett talks about them a lot, but maybe it's because they don't have the same spotlight and the same high PE. We'll just take it as a discount. We'll take it as a gift.
Definitely. That there's so many good companies out there, and I do get nervous that it feels like the diversification we have now is just between hardware, software, semiconductors, just all the different digital tools that we need and data centers and all this like infrastructure that's going to be in this digital economy that has nothing to do with cereal, cigarettes, gas, Coca-Cola. Like these are things of the past essentially in terms of making money. And I don't love that as far as market composition, and it's a whole different conversation about the S&P 500 concentration, but just the asset classes or the sectors, excuse me, that we're focused on is something that I also just find concerning and think should be on people's radars a little bit.
Yeah, when you have some of these PE ratios that are just kind of obnoxious, and you just have to wonder, are the returns that the market's been giving us in the last few years, is it justifiable based off the real growth that we've been having as an economy? I don't
Hmm.
know. I don't think it really has. If the economy GDP is growing 3% a year, the S&P's growing 15%, you know, that's it's just interesting. So
Yep. Oh yeah, I totally forgot I put in that bullet point there. And I do get it that the earnings of these big companies have still like gone off the charts and that, increasingly with AI, maybe they can get rid of excess workforce that they don't need or just able to optimize their business to really cut costs, but how much you can expand your top line and just sell more product, how like from where you already are as a Meta, Google, Microsoft, where you're already bringing in so much revenue to amplify your earnings enough to make that PE ratio justifiable is going to be hard for them to do. But we'll see. We'll see.
we'll see. I mean, I'm not going to stop buying their stock, so
True.
find out. But how about with some of these Mag 7 companies? We have this little graph here. showing the sheer amount of CapEx is being spent to fund these AI hyperscalers and all these endeavors, data centers. And so for reference, in 2004, I believe, what is that? Am I correct in saying this? I guess around like 10% of operating cash flow was spent on CapEx.
Hmm.
Now it's a little under 50 or no, it's
Right.
above 50%. Yeah, it's like 50, 54 maybe.
Right. Nuts.
54% CapEx. It's going to data centers. It's going to try to try to win the AI race, which is insane.
Right. And I just like brought up this point just to try and dig in a little bit more because we've discussed this at length, but just trying to figure out where exactly that money is going, like and trying to look back at some of their earnings calls, and it really is data centers, data centers, data centers that we like need more compute power. We need, more infrastructure to grow our cloud business, and that's something that makes a lot of sense to me that Google has a big cloud business, Amazon has a big cloud business, Microsoft, I didn't realize had a big cloud business. And that is a big reason why they're buying these data centers, but that is not a big growth driver, I don't think. I don't know how much people are going to spend extra for effectively just like data storage. That's not the big story. The big story here is this AI infrastructure and what that's going to look like. And I think for a lot of these companies, it's still a big question mark. I'm not exactly sure what Meta's AI angle is, but I guess all these other analysts do. But just wanted to kind of jot out some of these bad case scenarios for all this CapEx because, as we were saying earlier, if the return on investment here isn't good, then that's going to be a real problem for everything because of how concentrated the market is. But I kind of jotted these down. If there are any, I just wanted to pass it to you if there are any that either on this list or not that you kind of thought were a big risk to these stocks.
Tough question. I mean, it's just like so for right now, every one of these companies is safe for the time being, just because everyone's just like, oh, they're just investing in AI. Oh, they're just putting it into data centers. They're building their data storage services. But let's say it doesn't work out. Recently, a lot of buzz has been going around about this Loveable AI. I'm sure you've seen it. It's backed by like Mark Cuban, fastest million to $100 million valuation ever. I mean, it literally took them less than a year. It's unbelievable. So basically, what they do is they create full stack websites and applications, basically allowing you to build apps without needing to code. I don't know how to code. This is
Me neither.
unbelievable. And in a world where everyone's trying to start a business and become an entrepreneur, this is selling shovels in a gold rush. I mean, this is a really, really cool thing. But I mean, this is like my concern. It's that artificial intelligence is not that it's a concern, it's a great thing that it's democratizing the game. It's making it easier for everyday players to get involved. You don't need this massive CapEx, but that's where it gets concerning for these companies that are pouring all this money into AI. What if you have something like Loveable and more AI that comes out that just allow everyone to do what you're doing at a fraction of the cost? I think Loveable's charging like $20 a month, and these guys are spending hundreds of millions, billions of dollars, a month on their efforts. So that's like my bad case scenario. And of course, we always go back to DeepSeek and what's going on there. But I don't know. Any thoughts from you, Adam, on that?
No, I think that is an awesome example. And we're looking at a chart here on the fastest to get 100 million of annual recurring revenue. And it looks like that they did it in basically
Wow.
half a year, almost a year, or less than a year. And that is, I mean, that's incredible. And the product is absolutely incredible. And to think that a lot of these companies that exactly what you said is that we've kind of waited around earnings call after earnings call. Oh, we're spending all this money in AI. Like, stay tuned, stay tuned. And eventually you're going to have to act really fast, or you're going to have to try and start buying up some of these guys because like what that is doing is completely changing the game. And that's kind of why what I was bringing up this point about open source technology putting a lot of pressure on the prices is that like when all this stuff is digital and in my mind makes it kind of easily copyable when you have AI that you make so smart that can basically recreate these products is that's going to be that's going to be a real problem when you're trying to create pricing power and going to charge $1,000 a user or whatever that is in their dreams. So that I think is a really good AI bear case scenario that even if everything is just like you imagine and that is an awesome product, is that this thing can still totally crash and burn from a business standpoint. And I think that that was also kind of one thing that I found interesting when we talked about AI and unemployment. And I'm kind of a big believer in that camp, I guess, at this point, that AI is going to create some unemployment and deflation. And I think that what isn't really considered is that, like thinking about the real economy versus the stocks, is that in the real economy, consumers are going to get crushed if they're getting laid off and they're not going to have the money to spend for a $20 ChatGPT subscription. And oh, by the way, ChatGPT is losing a ton of money, so they're going to have to 10x their prices and they're not going to pay for 200 either. So I think that there are a lot of, even if AI is as awesome as we think it's going to be, like it still can just be a bad business.
Yeah, I mean, that's the real doomsday scenario.
And they seem super believable. I don't know about
Yeah, it
you.
sounds, nothing you said sounds even slightly unreasonable. It sounds very reasonable. Of course, we'll push back and be like, AI is going to create jobs, but I
Mhm.
think at a net level, it's probably going to require less jobs as an economy. And maybe that's not such a bad thing in a world where we're depopulating.
Okay, nice.
Yeah. So we have this little Wall Street Journal article, and these guys wrote a book, and they were basically talking about how if there was like a major event or some sort of disease or a natural disaster that wiped out tons of the population, or you knew was going to wipe out tons of the population, everyone would take notice to this, and everyone would be very concerned about it. But it is happening right now, and he's kind of blaming us and saying it's kind of a manual error in a weird way. It's a very interesting article, and I'll let you kind of explain it a little better than me, but that's just kind of what we're jumping into right now.
Right. So just to kind of give the greater context, and we're looking at a graph here on the bottom that shows from July 2015, we're almost at 4 million births a year to now we're at 3.6 as this data was released in March 2025, so Q1 2025. So that's kind of the larger context is that people are having less children combined with the fact that we're having less immigration and we're actually deporting people. So that is just putting a pressure on how many people that we have. And there are a couple reasons why this is happening. The first one is that, we live in this highly digital, highly specialized age where people have to go to school for a lot longer than they used to. You can't just give them a shovel and tell them to, start farming, that there is even farmers have to be really highly educated on what they're doing. And that makes that makes parents put a ton of money and a ton of time into their kids and makes kids more expensive in general. So that's kind of my theory, but there are certainly a lot out there of why people are having less children, but that this is a problem as far as these authors think because of the ability to generate new ideas to get us out of problems. So having more people, you have more inventors, you have more good ideas floating around, and you're able to spread out the fixed costs from a business framework of if you are starting a business and you're gonna, endure all these fixed costs, it makes it a lot more profitable at the end if you're selling to 8 billion instead of 4 billion, that's something that really matters. So that's kind of the general thesis here, and I just thought it was interesting because it seems like this is an issue that no one seems to really care about.
Under the radar, under the radar for sure. But do you think we're gonna need all these idea generators in a world of AI?
That is a good question. That is a good question. And I wonder too if it feels like that there's some complaints about, cities getting overcrowded and us having too many people. And I kind of like want your take on, I don't know, maybe the positives and negatives as you see them. I don't know how you think about that.
Yeah, I mean, I'm a huge believer in just the human spirit and the human element and something irreplaceable from AI as much as it can do. I think humans are still going to be the idea generators and the creative ones and really just projecting that spirit. Not to get too philosophical, but I think at the end of the day, that's what's going to drive our economy and that's what's going to create opportunities. And AI is just going to strengthen that. But on the idea of overpopulation versus underpopulation, I mean, I feel like my whole life I've only heard about everyone being like, there's too many people in the world. There's not enough food to go around. There's not enough things to go around. But they make some good points. And as you're talking about the fixed costs and spreading that out throughout people, and it might honestly just come down to the fact that it does cost too much money today to raise children, and we can kind of connect this to our housing talk and just how expensive homes have gotten. Home sales are way down. Mortgage applications are creeping up, but home sales aren't following it. So maybe that's the real issue. People just can't afford to live, and if they could, there'd be way more people here.
Yeah, I think that that is true too. Like the cost of living has certainly gone up, and all the education that we need too. I'm a real big believer in that sort of thesis that, and I don't know how we kind of reverse that, of that people need to be so educated to be commercially viable and to, contribute to any of these tech companies and AI stuff. And we're pretty well educated people, but the people at Nvidia and stuff, that's a whole different level still. And it's just kind of insane to me how we can recover that. So I don't know, but I think it is a good time to, pivot into this housing conversation. I kind of put a couple graphs of where the people are going, and also what that means as far as housing prices. And we've seen a lot of movement to the Sun Belt, and we've talked about that on here before. But what I kind of thought was interesting is pairing it with this other graph where the rents are moving up the highest, both in like the year over year and also just in the recent months. So tracking both like the short-term momentum and like the year over year growth. And the one that stands alone is San Francisco, and the one in the bottom left corner is Austin, Texas. So kind of bizarre how much, timing matters, and what makes a good real estate market isn't always just what makes a good place to live, and that if you buy some of these things at the wrong time or you build at the wrong time, you can get in a really tough situation.
I mean, we're seeing that with the Sun Belt, right? You're seeing a real overbuilding issue. I was reading a statistic. It said that multifamily values have come down about 20%
Whoa.
since their peak. Um, and that is the largest drop off since the global financial crisis. So
Wow.
while it's better that we're building and we're creating more housing, it is going to take a little bit of time to lease up and really stabilize these properties. But I don't know. Here's a little theory I have. I mean, I think when we're older in another few decades or so, I don't think people are really going to own homes like they have. I think renting is going to be the majority. And if you own a home, you're really up there. I don't know. That's a little theory I've got, but I
I
mean,
I love that. I love that.
seems
And
like
I'm
where we're
actually
headed.
100% on board. And here's why. I think that if you are a renter, you have someone who is, taking care of your toilet, doing the maintenance for you. You can leave whenever you want. You have that flexibility. And also, I mean, say you buy an apartment that you can like rent out, and you can rent it out at a 6% cap rate or something like that. But if you take that money instead and invest in the markets and decide to rent, instead of buying a property, that you can probably make 10% or whatever in the market based on the graph that we shown above, sometimes way more, and rent, then that seems like a great outcome. So I see a lot of advantages to the renting lifestyle, and especially with, our parents' generation were a lot more handy with fixing a toilet and stuff when stuff breaks, and our generation not so much.
I don't know how to do anything.
Me neither.
Maybe the bare minimum. I don't know. But yeah, you bring up some good points. I mean, maybe maybe there'll be a robot cleaning your toilet or fixing your HVAC. So we'll see. All fun things to consider. But yeah, there is a real housing crisis right now and affordability crisis. And I, in my opinion, that's what's driving this depopulation, especially in the United States right now, and something we're gonna have to fix, and it's gonna come down to additional supply of housing. So we'll see what happens again, but it does look like there is gonna be some hope there, at least in the right places.
I think that that's right. And I think hopefully in the near term, I think one thing that's probably slowing down home sales is that people locked in mortgages when they were way lower than what they are now. And people, moving from your 3% mortgage to a 6% mortgage is something that people don't want to do. And especially if they think that, rates are going lower, that they can suck it up and stay in their home for another couple of years.
Just toughen it out for who knows how long. Even the next Fed chair comes in and Trump tells them the slash rates to 0%. We'll see.
We will see. We will see. But I think that's all the content we got through today. That I didn't realize how thick an episode that was, but we covered a lot of ground there. That was awesome.
We did some big macro topics, but it's been a good, I think, good things to bring up, and we'll keep referencing a lot of these things, I think, in future episodes.
Definitely. Definitely. Well, thank you to everyone for listening to our 15th episode special. The long road to 20 begins now, but we appreciate everybody listening.
Thanks, everyone. Take care.